Hi, and welcome to the final bar. It's Tuesday, April 30th, 2024. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of technical analysis. Today in particular, we're going to talk about some non-technical things as well. We have a really good guest, Gina Martin Adams of Bloomberg Intelligence. I followed Gina's work for many, many years. She is fantastically smart and very well spoken, and does a great job of linking the technical to the fundamental and the macro. I think you'll enjoy my conversation with Gina, trying to make sense of things during a busy earnings week, during the Fed meeting today, and then tomorrow. Tomorrow, of course, we have the Fed, all the earnings we've talked about, AMD and many others reporting, Amazon today, and a lot more coming this week. A lot of charts to dig through. At the end of the day, technical analysis is all about what the markets are telling us in the form of price action. All of the buying and selling, the fear and the greed, the optimism, the pessimism, supply and demand all come together to price. And that is how, that is where things are actually transacted. That is fact. By analyzing those trends over time, I was taught we can have a better sense of where things may be headed. With that in mind, let's get to our market recap and look at how the charts evolved today. Kind of a late stage sell-off, the opposite of yesterday. But before we get there, let's talk about a poll question. Ask you very simply, what do you think happens at this week's Fed meeting? About 90% of you, I think, have the right idea, which is keeping rates the same. You know, there is a chance the Fed could raise rates or lower rates. Highly unlikely, certainly possible. And I would not fault you for thinking about what that might mean for your portfolio, what that might mean to the markets. Market essentially pricing in almost a 100% chance that rates are kept the same at this week's meeting. That means we look forward to the upcoming meetings through the course of 2024. One of the challenges, I would say, with this market is if rates continue to stay higher for longer. One of the issues we've seen here as we get to the charts today are the fact that rates overall have been trending higher. When we're thinking about the market environment as analyzed by the Fed, their data-dependent perspective, inflation's still kind of an issue. So we'll see if we do get any change at this week's meeting, but highly unlikely. Looking at the charts here, you see the S&P, the NASDAQ, the Dow all rolling over big time in the last 30 minutes. As always, it's a lot of fun doing a market recap show after the last 30 minutes of trading. I can't tell you how many times this has happened where the market has a particular look and feel, and then everything changes in the last 30 minutes. Yesterday, from 3 to 4 p.m., it was a big time rally, almost making a new swing high for the day. Today, it's all about distribution going into a bunch of earnings reports after the close today. The S&P damage done, down about 1.6%. That's closing just around 50.36. So back below that 50-50 level, which we talked about as a key line in the sand here in recent weeks. The NASDAQ composite over 2% lower to 15,658. The Dow about 1.5% lower. Mid caps, small caps all down as well, with the S&P small cap 600 down 1.9%. The VIX, the only thing on the green here on our front page, back above 15. And what happened yesterday, market kind of rallied into the close. The VIX came off, went below 15, closed below 15 for the first time in probably a couple weeks. We'll look at the chart here, time permitting, in a few moments. Today, right back above 15. So the reason why I keep talking about that 15 level, I mean, again, it's not a trading system. It's not the world's most perfect indicator. But for me, thinking of the VIX in terms of different levels, different thresholds, that tell you the environment is different. Instead of trying to analyze a particular VIX level and what that means, I just keep it simple. Is the VIX below 15? Is it below 15 to 20, 20 to 28, 28 plus? And each of those ranges implies something different about the character of the market as described by the volatility conditions. VIX between 15 and 20 is pretty consistent with pullback phases, not end of the world corrections. That's a VIX above 20, not disaster scenario, secular bear markets, that's a VIX above 30. VIX between 15 and 20, that is, means brief pullback at least, and that's where I think we're at right about now. Looking at interest rates, you can see bonds sold off along with stocks in the last hour. So yields all sort of rose going into the equity market close, and bond markets closed a little bit earlier at around 3 p.m. Eastern. But see the long bond yield finished just below 4.8%, the 10-year yield just below 4.7%. 5-year yield just slightly higher from the 10-year point. The short end of the curve, of course, is still elevated relative to the rest of the curves. We still have that inverted yield curve. With the Fed coming up today and tomorrow, press conference, and Latest announcement will be afternoon 2:30 Eastern. We'll certainly cover that on our closing bell show tomorrow and review what happened coming after that announcement. But I would certainly be keeping an eye on that dot plot as the Fed governors project where they expect interest rate policy to be heading. Be interesting to see how that might have changed given some of the overheated economic indicators we've seen even as recently as today. Bond markets, as I mentioned, coming off, so the TLT was down about 0.9%. The dollar pushing higher, the dollar index up about 0.6%. $1.07, this is the dollar ETF UUP. On our platform, $USD is a dollar index, basically combined by a bunch of different spot rates of different currencies. You combine that into a dollar index. Dollar above 107 could be a dangerous breakout. We're not quite there yet. All red on the page looking at commodities. Crypto is kind of red as well, as you'll see in a moment. The DBC, which is a broad commodity ETF, was down 1.3% today. Gold and silver both down. Silver was down over 3%. Copper prices, crude oil prices, even soft commodities like corn, all in the red today. So this is basically a rotation away from everything but the dollar is the way I would generally describe what happened today. Bitcoin, talk about a big time reversal to the downside. Here's the last 2 days. And as a reminder, cryptocurrencies like Bitcoin do trade 24 hours a day. So when we talk about percent changes, we talk about a closing point. It's kind of like the currency markets. They trade 24 hours. And so you're basically picking an arbitrary point of time and calling that the close, just so we can analyze those trends over time using the technical toolkit. But these things are fluid and they move consistently. So thinking of percent changes, it's more about the trend more than anything in my experience. Bitcoin has been briefly here below 60,000, which was that lower end of the range. We've been talking about 60K to 74K now for a couple weeks now after Bitcoin peaked out earlier this year around 74,000. We're now slightly below 60,000. We'll get to that chart here in a few if we can. But for today, Bitcoin, Ethereum, both down pretty significantly. Ether prices down over 8%. Ether now below 3,000. Let's go to the 11 S&P sectors. You can see it's all red, but a couple of them did a little bit better than average and outperformed the markets. Healthcare, consumer staples, utilities. Healthcare was essentially flat for the day. Consumer staples and utilities both down about 0.5%. So outperforming. So these are fairly defensive sectors, right? Healthcare is kind of a mix of things, but consumer staples and utilities almost pure defensive plays. So those did the best. What was struggling today? Energy with the XLE down 3%. Consumer discretionary, the XLY down 2.4%. Tesla got dinged again, down over 4%. It might have been even worse here. We'll look at that in a second. But Amazon, of course, reporting after the close today. Technology, number 3 from the bottom, down 2.2%. So when those sectors like XLY, XLK, XLC, if those are down, the market's going to be hurting for certain, as they say, because there's such a big weight in our benchmarks. Now, the market trend model, which I often refer to, as of yesterday's close, the short-term models had popped higher for a lot of these indexes. They're right back below, and I was going to say they're probably refreshing as we go live with the show because of the deterioration going into the close. I know our models are running as we speak, but most likely going to turn back negative, at least on the short term, given the sell-off that we saw today. We'll keep an eye on that through the course of this week. Looking at the Magnificent Seven and Friends, and again, have had some additional great ideas from all of you on what to call the new growth leadership, whatever emerges from this downtrend cycle we find ourselves in. But for today, Meta, NVIDIA down, Netflix down as well, but not as much as others. Meta, the best performer of this group, it's still down 0.6%. NVIDIA and Netflix both down 1.5%. Tesla, wow, ended up really deteriorating going into the close, down about 5.6%. Amazon reporting after the close today, down 3.3% going into today's earnings. So, boy, the end of the day really brought in some negativity to some of these charts here. Let's try to make sense of things. And again, that's one of the reasons why you wait for the close every day and why I hesitate to draw too many conclusions during the trading day, because that last hour is where a lot of institutions, if not most of the institutional volume, happens through the course of the day. So a lot of institutions will wait till the end of the day to move big orders because they want to minimize the impact on the markets. That's why a lot of times in the last half hour, you see a big spike higher, a big spike lower. That's where a bunch of volume comes in. Those are some of the larger trades that bigger firms are trying to get in before the close. By doing it at the end of the day, they can minimize impact and not completely skew the rest of the trading day because of that volume, because a lot of people try to front run additional trades they might want to do. So waiting for the close, I think, has some value on a day like today. It shows that the institutional measure was really more distribution than accumulation. The S&P was testing the 50-day moving average over the last couple days. That's Friday's gap higher. Monday's session was a bit of a doji candle right at the 50-day moving average. Boy, today rocking right back lower and distributing. This isn't a, what would we call this, an evening star candle? It's not quite that pattern because it's not the perfect setup, but kind of close to that. We have a big up day, sort of a choppy sideways day, and then a big down day. That's the kind of basic premise of what's called an evening star candle, which is when you have that sort of move, a move higher, and then a pause, and then a big move lower over a 3-day period. So what's interesting going into the close now today, we're back below 50-50, and that was one of the things that made this counter trend rally so compelling, was the fact that we got back above 50-50 less than a week after breaking down below that level in mid-April. Now we're kind of right back below there. Also note that as of today, the RSI popping back lower. So on this brief rally to the 50-day, the RSI not getting above 50. So if we would sell off further from here and get down to this sort of range, you will look back and see that particular pattern, this failed attempt to get above the 50-day moving average, the RSI failing to get above 50 down here at the bottom. That's pretty classic behavior for a bearish trend, right? For a downtrend. This could be, I think, a sign that this sort of counter trend rally may be near ending. Now, even just a trend line using the recent swing lows has not quite been violated, I mean. So let's not draw the disaster conclusion too much, but certainly showing some further weakness here, and particularly getting below 49.50, which was the swing low from mid-April. I think that immediately opens the door to 48.20. That's a 38.2% retracement of the way down to the October low. Probably haven't made much of a secret. That's kind of where I see things headed. I've seen this as a counter trend rally with a potential downward move. Now, we've got a ton of earnings happening right now, probably being reported with Amazon, AMD, super microcomputers, Starbucks all coming out after the close. So a lot of names that have market moving potential. The Fed tomorrow. So this was a bit of a distributive day at a time which is normally kind of quiet going into a Fed announcement. So a lot to be seen here. And again, keep an eye on that 49.50 level and see if we get follow through below 50.50 tomorrow on Fed Day. Wanted to just briefly look at the NASDAQ 100, the QQQ, and actually I have this chart. I have a chart list called Equity Market Indexes. I have the Qs as sort of my go-to QQQ chart. I just want to show this. When you think about how the market has evolved over the last 6 months, coming off of the October low last year, fourth quarter, obviously an uptrend of higher highs and higher lows, the momentum stronger with the RSI becoming overbought on rallies, not getting much below 50 even, and nowhere near 40 on pullbacks. Look at how that has all changed. We're now gone from above an upward sloping 50-day to below a downward sloping 50-day. We have this big bearish momentum divergence, January, February, March, now rotating lower. The RSI actually briefly touching the oversold level for the QQQ about a week and a half ago. That's as we hit around 412, 415. We've now bounced higher, failed to get back above the downward sloping 50-day moving average, RSI stalling out at 50. So on the tactical time frame, I would say even with this counter trend rally, still more bearish than bullish by my read, but back above the 50-day RSI pushing above 50 and especially above 60 could make this chart quite attractive here very, very quickly, but I think remain to be seen. I think you want to wait for the evidence to tell you that things are different. My default, my sort of base case is further weakness from here. We'll see what happens for sure. Looking back at some a breadth indicator or two to continue our market recap, I do want to talk about the percent of stocks above key moving averages. With today, right, yesterday's close, we got to right around 50%. I think it was right at 50% of stocks above their 50-day moving average versus below. Today, down about 40%. So literally, in the last one day, just today, about 10% of the S&P, about 50 of those 500 names were above their 50-day yesterday and then failed to hold that 50-day together. So, came right back below it today. So I think you're still seeing distribution. That's your tactical reading. The long-term reading is up here, which means, most stocks are still above their 200-day. 72% of the S&P members are above their 200-day. So the long-term breadth's still okay. The short-term breadth is what's a little more concerning. Let's look at the chart of Bitcoin here very quickly. We're going to go to the intermarket analysis look. We'll look up Bitcoin here. As I mentioned, I think it's a little premature to declare this a broken trend, but boy, it's really close. We're right at that point because we're right at support. We talked about the range-bound nature of Bitcoin over the last 8 weeks or so. If you go back to late February now to late April, you can see that we've sort of settled into this range between 74,000, which was the peak, just slightly below that in early March, and around 60,300, we'll call it. That was your swing low in early March. It's also a 38.2% retracement of the way back down to that last big swing low in January. So looking at the range of 2024, we're right testing support. That was tested again in mid-April, now tested again as we speak. So Bitcoin holding 60,000 is not a bad chart. That's a corrective move within overall a constructive pattern. Now we're below a downward sloping 50-day, which doesn't make me feel particularly good. The RSI is breaking below 40, which I would argue is more of a negative sign. We've briefly traded below support, which I don't find particularly bullish either. So overall, this certainly seems like it's heading lower rather than higher, but we've not completed that breakdown of support. I'd be keeping a hawk-like watch on that level, because if we would break below there, I would argue the next logical downtrend would be sort of 50 to 52,000. 52,000 would be a 61.8% retracement. That is your next major Fibonacci retracement down. The 200-day moving average is slightly below there. So that could be that confluence of support, the next big move for Bitcoin. That would be a major league haircut. That'd be about a third of the value, going from 74,000 down to 50,000 in a month or two. But it has happened. I mean, the history of Bitcoin is marked with significant drawdowns, even much worse than that, going back over time. Maybe that's what's to be had here going forward. Let's keep an eye there. Let's finish off looking at some individual stocks. I do want to highlight with something like Apple, and again, all of these candles changed in the last 30 minutes here, but I did want to highlight, I think we mentioned this on yesterday's show. Yesterday you had a shooting star candle. We gapped higher Apple on Monday's session. We opened above the 50-day moving average, traded all the way up to 176, but then closed back almost at the lows of the day. You could call that a shooting star candle. You could also call that a gravestone doji candle, depending on how much you think this open and close are at the same level. It's pretty close enough that I think you could argue both of those. That's a short-term bearish sign, telling you the next 1 to 3 bars are most likely lower. Today really looked like almost the same candle until the last 30 minutes of trading is when all of that happened. We closed just above 170, so certainly continuing distribution that was implied by yesterday's pattern. Another one that I want to highlight, and again, when these mega cap growth names show concerning candle patterns, I think it's important to watch. Yesterday you had, what do we call this? It's called a hanging man. We're going through the deep library of candle patterns here, but it's still there somewhere in my head. This is called a hanging man, which is where you have a rally, open and close near the highs, and then a long lower shadow. We close back at the upper end. That's a reversal candle telling you that basically the buying power has exhausted. We failed to get above Friday's close, and now today distributing a little bit as well. Still above the 50-day, so not a bad chart, let's be clear, but in the short term indicating some weakness. Names moving today. We'll just run through a couple of these here very, very quickly. McDonald's actually opened much, much lower. It actually opened for a new low for the year, but look at the accumulation. Even with some weakness going into the close, it got all the way back almost to yesterday's close. I think that's an important data point for McDonald's, right? When you have a big gap at the open, that could have gotten way worse as investors were panicking and unwinding positions. This implies that people are actually buying into the weakness out of the open today and pushing the price much higher. I would argue that's actually an encouraging outcome from what looked like a very negative day. PayPal, kind of the opposite, gapped higher. We talked about this chart, its ability to get above 68, which would get us above that resistance level. It did open around 70, but by the close, we're right back to that level. So I would argue that is not a valid breakout just yet. Remains to be seen. We'll see if it happens. Eaton Corp flashing a bearish engulfing pattern. We opened right around previous all-time highs around 330, but by the end of the day, we'd engulfed the previous day's bar. So this is actually a bearish short-term candle telling you the next 1 to 3 bars most likely weaker rather than stronger. Boy, so many other charts we could get through. We'll have to wrap it here. But as a reminder, Amazon, AMD, SMCI, super microcomputers, so a couple big-time AI plays, and Starbucks, of course, all reporting after the close today. Keep an eye on some of those because while they're not necessarily broken, some of these charts, they certainly haven't been going up recently. SMCI, AMD, arguably in downtrends of lower highs and lower lows. That would have to change, and the momentum would have to improve quite a bit. the bull case from here for the S&P and the NASDAQ, I would argue, means stocks like AMD and Amazon have to start looking a lot better, a lot quicker, because right now the momentum and trend characteristics are decidedly negative. That's our market recap for today. So many charts here in earnings season with the Fed meeting coming up after or during the day tomorrow. So keep an eye on all of your charts here on Stockcharts.com. Couple quick announcements before we bring on today's guest, Gina Martin Adams. First off, we've had so many great questions come through our mailbag over the last couple years. Please keep them coming. The mailbag is almost empty as I prepare for Friday's show, bringing some of your questions to the forefront. So if something's been bugging you, you're looking at certain indicators or patterns or tickers, and you just want a second set of eyes on what you are doing trying to navigate these markets, we're here to help. The final bar at stockcharts.com is our email. Here on YouTube, you can just drop a comment below the video that you're watching. We'd love to hear from you, and we'll hope to answer your question on our next mailbag show, which will be coming up Friday of this week. I will be traveling, boy, this is coming up in a week or two. Next week, I'm going to Silicon Valley, week after next, that is, going to the Money Show Investment Masters Symposium. This is an in-person event. So fun coming through the COVID era that we're back to doing in-person events. It will be right by the airport in Silicon Valley. I'll be doing three things. I'll be doing a workshop on I think, Tuesday, a meet and greet. So please introduce yourself and let me know you're a watcher of the show if you attend. And I'll also be doing a 2-hour masterclass called 7 Questions to Ask Before Every Trade. You can scan the QR code on your screen to sign up for that event and hope to see you there. Please take time to say hello if you do. Also, we were almost wrapping up our Stockcharts 25th anniversary sale. 25 years ago, Stockcharts.com was born. Our founder, Chip Anderson, had left Microsoft, where he started his career, and had bought the domain and started building tools for investors. It's turned into the fantastic suite of tools that we have, and as a premium, as a paid member, you have best access to the best tools. So go to stockcharts.com/special or scan the QR code to sign up for a paid membership. You will not regret it. There's so many great features that we reserve for our paid members. And if you are already a member, make sure you go there as well, because we'll give you an even better deal. It's a great opportunity to extend your membership a little bit further. I want to welcome on today's guest, Gina Martin Adams. Gina is the Chief Equity Strategist at Bloomberg Intelligence, coming to us from Bloomberg headquarters in New York. Gina, good to have you back on the show. How are you doing these days, okay?
Thank you, Dave. It's great to be here. Thanks for having me. And everything's good. It's nice and almost spring here in New York. We've had a couple of warm days for a change, so it's
not too bad, right? I think we're transitioning. The market's, of course, transitioning as well. Sort of a frosty feel to April so far. We're sort of, certainly January, February, March had a particular feel, a particular character. April feels very different. As we're looking at your chart of the S&P now transitioning into May, where are you at with the current pullback scenario and conditions going forward here?
Yeah, so a couple of things really stood out to us by the end of the first quarter. As you can see on this chart, RSI momentum, which is the bottom panel of the graph, had peaked all the way back at the end of 2024 and was deteriorating as the broader market was rallying through the first quarter. So this became really obvious by the end of March as a cue that, maybe the momentum non-confirmation was ultimately going to catch up to stocks. At the same time, we saw pairwise correlations, which is another indicator that we follow in our broader market health checklist. Pairwise correlations reached a -1 standard deviation below long-term average, and that typically is a sign of at least near-term tactical weakness emerging on the markets. And we've seen that emerge throughout the month of April. A bit of churn emerged for the S&P. That said, it's just been a very modest correction within the longer-term uptrend. When you have the 50-day moving average still well above the 200-day moving average, the 200-day moving average still rising, generally the uptrend still looks to remain intact. So our view is that we're in the midst of something of a second quarter chop as we look for new leadership to emerge in the S&P 500. We see a bit of cool down, and we see the RSI divergence with price ultimately closing before we can get past the chop.
It's so interesting. Obviously, we've had this initial pullback. I know a lot of people are probably everyone's struggling to differentiate a very buyable dip from the beginning of something very negative. I mean, at a high level, how do you try to differentiate between the short term, just another higher low kind of time to accumulate versus the beginning of something bad? Is it further technical deterioration? Would it be weakness in earnings we necessarily haven't seen yet? Like, what would be the warning signs you'd be looking for here?
Yeah, we run a 17-factor checklist of market health. And what we saw at the end of the first quarter when we updated it was Generally, you want to see more accumulation of positive trends, and we actually
Mm,
started to see a little minor deterioration, but all of the deterioration was in the technicals, actually.
mm,
So, from an earnings and a macro standpoint, we only continue to gather strength and confirmations of the longer term uptrend. We would need to see, the technicals turn from not only just minor negative cues to bigger, longer term negative cues and some accumulating evidence that earnings are indeed peaking again, that the
mm,
macro is starting to turn over. And we're just not seeing that yet. Excuse me. In terms of the technicals, some things that I would look for, I would certainly watch breadth. When you get to the point where less than 50% of the S&P 500 is trading above its 200-day moving average, that's usually a key trigger point for
mm,
me to think about this moving into a longer term downtrend. When the 200-day moving average itself is starting to turn over, when you get some MACD negative crossovers on the monthly charts, those are long-term turnover trends. And I think it's important to keep in mind that typically tops happen over a long period of time. So
mm,
you can get a lot of churn if we're at a major top. That major top usually gets some confirmations and some building of evidence across different components or different indicators. And if we are at a major top, then we're in the very, very early stages of it. So you want to get more
mm.
confirmation of that downward trajectory emerging. We just don't see it
Yeah,
just yet.
good points in there, Gina. I mean, 200-day moving average, we're well above it. It's still sloping higher. It's probably over 70% of the S&P members still above their own 200 days. So you're right. Those long-term signals we certainly haven't seen yet. Can we talk a little bit about interest rates? We obviously have the Fed this week. No real change expected, but certainly I know a
Yeah.
lot will be hanging on the comments from Chair Powell. Talk to us about interest rates and what stands out to you sort of at this kind of key juncture.
Yeah, I think the most important thing to follow is actually the 2-year Treasury because
Hmm.
it's the closest representative tradable asset with respect to the Fed funds rate. And it has been pretty meaningful as an indicator for both valuations as well as for the tech sector. This chart shows you the tech sector's relative price chart in comparison to the S&P 500 plotted against the 2-year Treasury. And you can see the two, at least over the course of the last 6 months, do tend to move in opposite directions. So the fact that we had the 2-year breaking a bit higher over the month of April did certainly weigh on tech stocks. And it does so because the market is pulling back anticipated Fed easing. So
Mm,
the Fed is important. I don't necessarily think we're going to get huge news out of the Fed specifically tomorrow. I think the Fed's been pretty good about telling us, look, we don't see the case to ease just yet. We still think we might get there later this year, but we're very data dependent. I think they're watching inflation numbers really carefully, but frankly, we've seen only accumulating supports that would suggest the economy is gaining momentum recently.
yeah.
And that really works against this idea that we need an ease to support the economy. So I think that we'll get probably more confirmation from the Fed that they're still on hold. They still see policy for right now as relatively adequate considering the dynamics of growth and inflation, and they need to see something change in order to spark an ease, or on the other end of the spectrum, a potential tightening if things do continue to improve and inflation fails to come down.
It's interesting. The Fed chairs have often talked about being data dependent. We have more data this week, sort of indicating the economy's a little stronger than probably would imply a rate cut. For those still trying to get their head around all of this, if we do get that rates higher for longer sort of environment, what would that mean for someone's portfolio? Where would you expect to see strength and weakness if we have persistent higher rates here going forward?
Yeah, it really depends upon the characteristics of the economy and the earnings
Yeah.
stream that are behind that persistently higher rate landscape, right?
Okay.
Higher rates in and of themselves are not necessarily bad if they're matched with an equivalent acceleration in growth.
Hmm.
And I think that that's been the characteristic that has really helped the market over the last year and a half is even though rates have been higher and generally are much higher than many people had anticipated they would be 2 years ago, the market has been able to recover over the last 18 months because economic momentum was improving, because earnings revisions were improving, because earnings recovery was really supporting the stock price gains. So, in an environment where let's say rates are flat through the remainder of the year, if that's purely because growth is better than anticipated, then there's still potential for earnings surprises to keep powering the market higher. I think it'll depend where those earnings surprises come from. The sectors that will rise or generally do better are going to be those sectors where earnings surprises are stronger or earnings growth pace is better. I think on the other end of the spectrum, you have to think about inflation these days, and this is definitely new for a lot of people in the market, especially, those of us who have been in the market for the last 20 or 30 years. We really haven't had to contend with inflationary
Mm,
dynamics in the equity market for a long period of time. But we do now. And to the degree that inflation is the big driver of that decision process, let's say that we are experiencing a deceleration in growth, but inflation is still uncomfortably high and maybe even strengthening. In that kind of environment, it's horrible for stocks, right? We don't want to see a deceleration in growth and high inflation because then we're going to see margin pressure emerge for companies.
yeah.
If that's the case, then you definitely need to see a much bigger defensive rotation in equities and probably a rotation into commodity sensitive plays in the equity market
Hmm.
to survive those kind of conditions. So I do think it'll depend upon what's happening in the broader economy, what's happening in the earnings stream as to what kind of leadership is able to survive and thrive in an environment of higher for longer rates.
Your last chart, Gina, and thanks for that, is looking at the small cap space. Small caps, in so many ways, have not really been the driver of
Yeah.
anything. They've sort of been lagging, pulling back along with the rest of the markets here in April. What's the outlook in the small cap space? More or less constructive, and why?
Yeah, so small caps is very, very frustrating right now. And I think that the one thing that's really been missing, from a technical perspective, I can't get too excited about this chart. We do
Yeah.
at least have a point of consolidation, sort of a range bound bottom that occurred throughout late 2022, 2023. We've broken out of that bottom. Um, it's not a decisive breakout, but what I will say is, at least on the retest that we've had here in April, we seem to be retesting those former highs created by that range
Yeah.
trade of 2022, 2023. So that's a potential positive, but it is still very potential because this chart is so indecisive. At least the 200-day moving average is rising now, right? I think that's an important characteristic to
Yeah.
point out. That red line is on the rise. The trend is higher. It's not a massive acceleration and it's not a big positive slope, which is what you would like to see in a recovery phase, but nonetheless, it is rising. So we're sort of cautiously optimistic that small caps can perform better. The thing I'm watching in small caps from a fundamental perspective, first, small caps are just now getting to the point of some form of earnings recovery emerging, and that should emerge in the second half of this year, which could help improve animal spirits and confidence in small caps, and that'll play itself out through a strengthening chart if it does indeed occur. The second thing I think you want to watch for small caps, though, and this is probably the biggest thing in small cap land, is IPOs. Without
Hmm.
IPOs, it's just really difficult to get too excited about small caps. That's where they get their lifeblood. That's where they get their optimism. Is these new companies that are coming into small caps tend to power optimism, power growth prospects, and we just have had no IPO issuance since 2021's SPAC issuance year. So if we can get some form of new IPOs coming into the small caps market, which would draw capital into that space, I do think that our chart could improve, but we'll see. For now, it's sort of a cautious optimism, but somewhat reserved given the fact that we've been through such a long-term bear market in small caps.
Gina, as expected, a beautiful balance of technical, fundamental, macro, all in a little meal for our viewers. I can't thank you enough for that. And especially during this week with earnings with the Fed. Thanks for giving us some time today.
Sure. Thank you so much for having me.
That's Gina Martin Adams. Gina's the chief equity strategist at Bloomberg Intelligence. I hope you all were paying attention. If not, please go back and review her comments about the relationship between the relative performance of technology, the interest rate environment. And what I love about her comment, I tried to maybe give her an opportunity to give a very straightforward answer. Rates go up, it's good. Rates go down, it's bad, or something like that. She gave a very honest answer, which is it depends. And there are a lot of moving parts. I think a lot of times we try to oversimplify. The reality is the markets are a complex system. So listen to people like Gina that have a good sense, a good experience, and a good sense of how these different moving parts are related. That's how I think you navigate markets in uncertain times. Great take there, as always, by Gina Martin Adams at Bloomberg Intelligence. Folks, we've got to wrap the show. Thanks so much for watching us every weekday after the close. Don't forget to watch all of our previous interviews on our YouTube channel. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.